silver didn't just go up. It broke. Over the last year, silver didn't behave like a normal commodity in a cyclical upswing. It didn't grind higher on inflation fears, or drift upward on dollar weakness. It dislocated. It accelerated. It detached from the assumptions that have governed this market for decades. And that's the first mistake most people are making right now. They're looking at silver's price and thinking, another rally, another speculative move, another commodity boom. That interpretation is dangerously wrong. Because what we're watching is not price discovery. It's system failure. For most of modern financial history, silver has existed in two parallel worlds. There is paper silver, futures contracts, ETFs, unallocated accounts, forward sales, swaps, claims on silver, promises of silver, IOUs written by banks, exchanges, and clearing houses. And then there is physical silver, bars and vaults, metal shipped to factories, silver that actually exists, can be touched, weighed, delivered, and consumed. For decades, the market functioned because almost nobody demanded the second. Paper silver was treated as interchangeable with physical silver. A futures contract was as good as metal. An ETF share was basically silver. Cash settlement was accepted as equivalent to delivery. That assumption built the modern silver market. And that assumption is now collapsing. Because today something fundamental has changed. Too many participants want the real metal at the same time. Industrial users don't want paper. Manufacturers don't want cash. They want silver delivered, now not later. And the system was never designed for that. The silver market has always operated on extreme leverage. For every ounce of physical metal sitting in a vault, there are dozens, some argue hundreds, of paper claims layered on top of it. This wasn't a secret. It wasn't a conspiracy. It was simply how the system evolved. As long as demand for delivery stayed low, it worked. But once delivery demand rises past a certain threshold, leverage stops being a feature, and becomes a weapon pointed inward. That threshold has now been crossed. What makes this moment different from past squeezes or speculative spikes is that the pressure is not coming from investors chasing price. It's coming from industry. Solar panel manufacturers don't care about silver charts. EV producers don't care about futures curves. Defense contractors don't hedge shortages with paper promises. They need physical metal or production stops. And when physical demand collides with a paper system built on the assumption that delivery would remain rare, the result is not volatility. It's rupture. You can see that rupture everywhere, if you know where to look. Not in headlines. Not in ETF inflows. Not in technical indicators. You see it in inventories disappearing, in futures curves flipping upside down, in lease rates exploding, and in prices diverging across regions that used to trade as one market. This is not a temporary imbalance. It is not a short squeeze. And it is not speculation run wild. This is what happens when decades of financial abstraction collide with physical reality. And once that collision begins, it doesn't reverse easily. Because you can print contracts. You can settle in cash. You can rewrite rules. But you cannot print silver. In the next part, we're going to look at how the paper-silver system was built, why it worked for so long, and why the very structure that made it efficient is now turning it unstable. Because to understand where silver is going next, you first need to understand why the old market no longer exists. And once you see that, the price moves will start to make sense. To understand why the silver market is breaking, you first have to understand how it was never truly physical to begin with. For most participants, silver has not been a metal. It has been a financial abstraction. The modern silver market is dominated by two hubs, London and New York. The London market, centered around the LBMA, sets global benchmark prices. New York, through COMEX futures, provides liquidity, hedging, and speculation. Together, they form the backbone of global price discovery. But here's the part almost nobody talks about. Neither system was designed to move large amounts of physical metal. They were designed to net positions, settle differences in cash, and roll contracts forward indefinitely. In London, the vast majority of silver trading happens in what's called the unallocated market. That means buyers do not own specific bars. They own a claim against a bullion bank. Legally, they are unsecured creditors. The bank may hold some silver. It may hold very little. It doesn't actually matter, because under normal conditions, delivery is not expected. COMEX works the same way. Futures contracts are traded in volumes that dwarf global mine production. Hundreds of millions of ounces change hands daily, silver that does not exist and was never intended to exist. Again, this worked because the system relied on a critical assumption. Only a tiny fraction of contract holders would ever stand for delivery. Most traders roll contracts. ETFs settle internally. Industrial users hedge price, not supply. As long as everyone plays their role, the leverage stays hidden. One bar of silver can support dozens of paper claims, and no one notices, until someone asks for the bar. And then another. And then thousands more. At that point, the system stops being a market and starts being a queue. This is where the illusion begins to crack. Because the silver market is not a warehouse system. It's a fractional reserve system, very similar in spirit to banking. As long as withdrawals remain low, it looks stable. When withdrawals accelerate, confidence collapses faster than inventory. And that is exactly what's happening now. What makes this moment especially dangerous is that the largest players are also the most exposed. Bullion banks don't just facilitate trading, they are the market. They provide liquidity. They write forward contracts. They sell silver they don't physically hold, assuming they can source it later. That assumption worked for decades because metal could always be sourced, somewhere from someone at a price. Today that assumption is failing. Not because silver doesn't exist on the planet, but because it no longer flows freely. The paper system depends on mobility. Silver moving from surplus regions to deficit regions. From vaults to factories. From one jurisdiction to another. Once that movement slows or stops, paper claims lose credibility. A futures contract is only as good as the confidence that delivery is possible. And confidence is a fragile thing. When market participants begin to question whether metal will actually be there when they need it, behavior changes instantly. They stop rolling contracts. They stop accepting cash. They stop trusting counterparties. They ask for delivery. And delivery is the one thing the system cannot scale. In the next part, we're going to look at the hard evidence that this transition is already underway. Not opinions. Not forecasts. Not theories. Actual data. Inventories. Vault reports. And the silent disappearance of silver from the places it's supposed to be. Because when the metal starts vanishing, the story stops being theoretical. And becomes unavoidable. If the silver market were healthy, inventories would tell you. Stocks would rise when prices rise. Metal would flow toward higher prices. Shortages in one region would be relieved by surplus in another. That's how commodity markets are supposed to work. That is not what's happening now. Instead, silver is disappearing, quietly, steadily, and almost everywhere at once. Let's start with London. The London market is the heart of global silver pricing. It's where the benchmark is set, where bullion banks operate, where the world assumes liquidity exists. But liquidity in London is not measured by total metal in vaults. It's measured by free float, silver that is unencumbered, available for delivery, not already pledged, leased, or tied to long-term obligations. And that free float has collapsed. What remains covers only a matter of weeks of global demand. That's not a buffer. That's a countdown. Now look at New York. COMEX inventories have been bleeding metal for years. Registered stocks, silver actually available to meet delivery, are a fraction of what they were just a few years ago. Yes, silver still sits in vaults. But much of it is locked. Locked in ETFs. Locked in structures that discourage withdrawal. Locked by owners who are unwilling to move metal across borders in a world of tariffs, restrictions, and shifting rules. Metal exists, but it's immobile. Then there's Shanghai. Shanghai inventories have fallen to levels not seen in over a decade. Physical silver in China trades at persistent premiums, signaling something Western markets struggle to admit. Demand is not being met. And here's the key point. These drawdowns are happening simultaneously. This isn't silver moving from one center to another. This isn't a temporary regional imbalance. This is a global drain. Every major repository is losing metal at the same time. Which raises an uncomfortable question. Where is the silver going? It's not going into investment vaults. It's going into factories. Into solar panels that will sit on rooftops for decades. Into electric vehicles that won't be dismantled anytime soon. Into electronics, infrastructure, and defense systems where recovery is slow, partial, or impossible. Once silver enters the industrial supply chain, it doesn't circulate the way investment metal does. Bars can come back. Coins can be sold. Industrial silver is consumed. And this is where the math turns brutal. 4 years now, global silver demand has exceeded mine supply and recycling combined. Not once. Not twice. Year after year. The difference has been covered by inventories. By drawing down the very stockpiles that back the paper market. That is not sustainable. You can drain inventories quietly for a while. Markets often do. But once stocks fall below a critical level, behavior changes. Hoarding begins. Leasing dries up. Delivery times stretch. And eventually, price stops being the clearing mechanism. Availability does. The silver market is approaching that point. And when inventories fall to levels measured in weeks rather than months, trust evaporates. Because everyone understands the same thing at the same time. If I don't secure metal now, I may not be able to later. That mindset is contagious. And once it spreads, no amount of paper liquidity can stop it. In the next part, we're going to look at the clearest signal that the market itself no longer trusts future supply. A signal most people have never heard of, but one that professionals fear. Backwardation. And the explosion of silver lease rates. That's where theory becomes panic. In a functioning market, the future is supposed to be more expensive than the present. That's not opinion. That's structure. If silver costs a certain price today, a contract for delivery 6 months from now should trade higher. Storage costs money. Insurance costs money. Capital has a cost. That upward slope is called contango, and it's the normal state of commodity markets. But silver is no longer normal. At multiple points, across multiple maturities, the silver futures curve has flipped. Spot silver trades above futures. Not just one contract. Not just briefly. Across the curve. This condition is called backwardation. And backwardation tells you one thing with absolute clarity. The market values silver today more than silver tomorrow. That should never persist in a metal market with adequate supply. Normally, backwardation resolves quickly. Arbitrage steps in. Traders buy futures, sell spot, wait for convergence. Metal moves. Balance is restored. But that mechanism relies on one assumption. That physical delivery in the future is certain. When that assumption breaks, backwardation stops being an anomaly and becomes a warning. Because futures prices don't just reflect expected prices, they reflect trust. When futures trade at a discount, the market is pricing in the risk that something goes wrong before delivery. Delay. Restriction. Default. Forced cash settlement. Backwardation is the market quietly saying, I'm not sure you'll get the metal. And then there are lease rates. Silver lease rates measure the cost to borrow physical metal. Not paper. Not contracts. Actual silver. Under normal conditions, those rates sit near zero. Often below 1%. Why? Because metal is abundant. Borrowing is easy. Supply is relaxed. But when silver becomes scarce, lease rates spike. And when lease rates explode, it means someone is desperate. At certain points, silver lease rates surge to levels that simply do not exist in healthy markets. Not 5%. Not 10. Explosive spikes that imply panic borrowing. Think about what that means. Someone needed silver immediately. So urgently that they were willing to pay extraordinary annualized rates just to access it. No rational actor does that unless the alternative is worse. And the alternative in this market is failure to deliver. Failure to deliver against a short position. Failure to deliver to an industrial customer. Failure to deliver into a system that still assumes delivery is optional. Lease rates are not speculation. They are not sentiment. They are a price on scarcity. And right now that price is screaming. What makes this even more alarming is that backwardation and lease rate spikes reinforce each other. Backwardation discourages arbitrage. High lease rates punish short sellers. The mechanisms that normally stabilize the market begin to fail simultaneously. At that point, time stops being your friend. If you are short silver and you don't have metal, every day costs you money. If you need silver and you don't secure it, every week increases your risk. This is how markets transition from orderly to unstable. Not with crashes. Not with headlines. But with incentives quietly flipping. In the next part, we're going to look at why demand is no longer flexible. Why this is not a speculative frenzy that can burn out on its own. And why industrial demand is turning silver from a financial asset into a strategic bottleneck. Because once industry enters a shortage, price becomes secondary. And that's when paper markets lose control. For most of its history, silver demand was flexible. When prices rose, investors sold. When prices fell, investors bought. Speculators came and went. That elasticity kept the market stable. But today, the marginal buyer of silver is no longer an investor. It's industry. And industrial demand does not behave like financial demand. A hedge fund can exit a position. An ETF can rebalance. A trader can walk away. A factory cannot. Solar panel manufacturers don't hedge silver for profit. They hedge it for survival. Each photovoltaic panel requires silver for conductivity. Not a substitute. Not an alternative material. Silver. When production ramps up, demand doesn't ask permission from price. It just shows up. Electric vehicles add another layer. Silver is embedded throughout EV systems. Power electronics, sensors, charging infrastructure, control units. That silver is not optional. If the metal isn't delivered, assembly lines stop. Electronics manufacturing tells the same story. Telecommunications, medical equipment, defense systems. These sectors don't buy silver because it's cheap. They buy it because without it, nothing works. This is the critical shift the paper market was never built to handle. Investment demand is price sensitive. Industrial demand is availability sensitive. As long as silver represented a small fraction of total production cost, manufacturers absorbed higher prices rather than shut down. And silver is a small fraction. Doubling the silver price does not double the cost of a solar panel. It barely moves the needle. Which means price is not the release valve. Supply is. And supply is not responding. Mining output has remained stubbornly flat. New projects take years, often a decade, to come online. Environmental permitting, capital constraints, declining or grades. You cannot accelerate geology. Recycling helps but not enough. Industrial silver is difficult to recover, slow to return, and often permanently lost. So year after year the same pattern repeats. Demand exceeds supply. Inventories fill the gap. Inventories shrink. This is how structural shortages form. Not through sudden shocks, but through persistent imbalance. And once inventories fall below critical levels, something else happens. Competition replaces pricing. Manufacturers stop optimizing cost. They start optimizing certainty. Long-term contracts, prepayments, direct sourcing. Anything to secure physical metal. That behavior pulls silver out of the open market and into locked channels, which leaves even less available for everyone else. This is why the paper market is losing control. Futures curves assume that supply will respond to price. Industrial reality says it won't. And when demand doesn't back off, prices don't correct. They gap. In the next part, we're going to look at what happens when geopolitics steps into this imbalance. Because supply is not just tight. It's being deliberately restricted. Export controls, tariffs, strategic materials policy. And once silver becomes a geopolitical tool, the idea of a single global market starts to fall apart. That's when fragmentation becomes permanent. Markets only work when goods can move freely. Silver is no exception. For decades, the global silver market functioned because metal flowed to wherever it was needed most. If London was tight, silver moved from New York. If Asia paid a premium, metal shipped east. Arbitrage kept prices aligned. That mechanism is now breaking. Not because traders forgot how to move metal, but because governments are putting walls in the way. China controls the majority of the world's refined silver capacity. Not the ore but the processing. And refining is where raw material becomes usable metal. When China introduced export restrictions, it didn't just tighten supply. It changed the rules. Suddenly, silver could only leave the country through approved channels, licensed entities, and politically acceptable transactions. Hundreds of smaller exporters, longtime suppliers to global industry, were effectively cut off. Silver didn't vanish. It became trapped. At the same time, trade tensions escalated elsewhere. Tariffs, counter-tariffs, and regulatory uncertainty made cross-border movement risky. Moving silver now carries political risk, legal risk, cost risk. Metal that would normally flow sits still. And when metal stops moving, markets fragment. That fragmentation is already visible in prices. Physical silver in Asia trades at persistent premiums to Western benchmarks. Under normal conditions, those spreads would be arbitraged away in days. They aren't. Because arbitrage requires delivery. And delivery is no longer guaranteed. What we're seeing is the slow death of this single global price. Instead of one market, we now have several. A Western paper market. An Eastern physical market. Regional pools of metal that don't communicate efficiently. Silver exists, but not where it's needed. And this is the most dangerous state a commodity market can enter. Because once fragmentation sets in, it feeds on itself. Hoarding replaces lending. Prepayments replace spot purchases. Governments start thinking in terms of reserves, not markets. Silver stops being a commodity and starts being a strategic material. That shift changes everything. Strategic materials don't flow to the highest bidder. They flow to the highest priority. Defense, energy, national security. When that happens, price loses authority. Access becomes the real currency. In the next part, we're going to explore what happens when the paper market finally collides with this reality, what exchanges do when they can't deliver, what history tells us about orderly interventions, and why rule changes always come too late for those who rely on paper promises. Because once trust breaks, it doesn't get restored with announcements. It gets replaced. Every paper market survives on one thing: confidence. Confidence that contracts will be honored. Confidence that delivery will happen. Confidence that rules won't change when pressure rises. History shows what happens when that confidence cracks. When physical shortages collide with leveraged paper markets, exchanges are faced with impossible choices. Deliver metal they don't have, or protect the system by breaking their own rules. We've seen this before. When markets become disorderly, authorities don't let price discovery run its course. They intervene. They pause trading. They rewrite contracts, not to protect participants, but to prevent systemic collapse. Silver is approaching that same fault line. If delivery demands exceed available physical supply, exchanges have limited options. They can force cash settlement, paying holders in currency instead of metal, often at prices disconnected from reality. They can suspend trading, freezing positions while stability is restored. They can change margin requirements, pricing out smaller participants and concentrating risk even further among large institutions. All of these actions have one thing in common. They admit implicitly that the market no longer functions as advertised. A futures contract that cannot guarantee delivery is no longer a commodity instrument. It's a bet on policy. And policy always favors the system over the individual. This is where counterparty risk becomes visible. In calm markets, nobody worries about who's on the other side of a trade. Contracts net out. Positions roll. Everything clears. In stressed markets, everyone asks the same question at the same time. Will my counterparty perform? If the answer is uncertain, liquidity evaporates. No one wants to be last in line. No one wants cash when everyone else wants metal. This is how cascades form. Short positions scramble to cover. Lease rates rise further. Available metal gets pulled off the market and locked away. Each defensive action worsens the shortage for everyone else. And the paper market, built on trust and leverage, begins to cannibalize itself. What makes silver especially vulnerable is concentration. A relatively small number of institutions dominate liquidity. They write the contracts. They make the markets. That works beautifully when supply is abundant. It becomes catastrophic when it isn't. Because if even one major participant cannot source metal, the problem doesn't stay isolated. It spreads. Positions unwind. Hedges fail. Confidence collapses. And suddenly the question isn't what is silver worth? It's who actually has it? In the next and final part, we're going to step back and look at what this means. Not just for silver prices, but for price discovery itself. Where real pricing will happen. Why physical markets are taking control. And what replaces a system that no longer delivers what it promises. This is where the old era ends. And the new one begins. What we are witnessing is not a spike. It's a transition. For most of modern history, silver prices were discovered in paper markets. Contracts traded in volumes far larger than physical supply, and the world accepted those prices as real. That only worked because physical delivery was treated as an exception. That era is ending. When inventories fall to weeks of supply, when futures trade below spot, when lease rates explode, and when metal can't move across borders, the paper market loses authority. Not overnight, but irreversibly. Price discovery doesn't disappear. It moves. It moves to where metal changes hands. To where delivery happens. To where buyers and sellers deal in reality, not promises. In fragmented markets, the price you see depends on where you are and what you can access. Premiums persist. Arbitrage fails. The idea of a single global benchmark fades. This is how commodity markets behave when materials become strategic. And silver has crossed that line. It's no longer just an investment or an industrial input. It's a bottleneck. Bottlenecks don't negotiate with paper. They force change. Paper markets will adapt the only way they know how, by reducing delivery obligations, rewriting rules, and protecting institutions. Physical markets will adapt by demanding prepayment, securing supply, and bypassing intermediaries entirely. Two systems. Two prices. One based on confidence. One based on possession. History tells us which one survives. The silver market people think exists, liquid, unified, interchangeable, is gone. What replaces it will be more volatile, more political, and far less forgiving of assumptions built on leverage. Those who understand that shift early don't need to predict exact prices. They understand direction. They understand why shortages don't resolve themselves, why supply doesn't appear on command, and why financial abstractions eventually collide with material limits. This channel exists to document moments like this. Not hype, not headlines, but structural change as it happens. If you want to understand how markets really work, when systems strain, when rules bend, and when reality reasserts itself, subscribe to Finance Archives. Because the most important financial stories aren't the ones everyone is talking about. They're the ones unfolding quietly right beneath the surface. And once they become obvious, it's already too late.